Hi, gentlemen. Good morning. Today, our topic is very specific for nowadays hot topic to sell in the market. This is a taxable calculation. How we can calculate taxable income of for corporate tax. This is not as easy as you can do VAT calculation, but this is too much tricky. You have to be do a lot of adjustment over here. So at least initial stage you have if you go for a calculation, there is a lot of 8 adjustment minimum. This is our agenda. So this is you have to be make taxable income for the adjustment. Article 20 of CT law. You have to be do minimum 8 adjustment for this one. You can start your computation with from your income statement, profit before and tax. Then you have to be do this adjustment because you have to be pay your taxable income. You have to pay tax on your taxable income, not your accounting profit. So you have to be adjust your accounting profit with this adjustment. Then you have your taxable income. After the taxable income, you have to be take 375 band 0% and then rest income will be 9%. Then you have to be pay tax on your taxable income. This is not normally in the market that you have to pay tax on your profit before tax. Not like this. You have to pay your tax on taxable income, not on your profit. So you have to be take profit before tax, and then you have to take this 8 adjustment. 8 adjustment, for example, if you receive some exempt income, in the exempt income is a local dividend. One example is local dividend. If you have invested over here and that company of the local company give you a dividend, and that dividend you added in your profit, in your accounting profit, but you have to be removed that exempt income from tax point of view because that company is already paying tax over that income. Exempt income is if you are paying dividend to the companies, dividend is not allowable expense for computation of taxable income. So that income you have to be removed from your accounting profit because that company is already pay tax on that income. So this is double tax. So they said you have to be remove that from your profit before tax. If you already added that one, so you have to be remove that one as from your income. So this is one of example of exempt income. Unrealized gain and loss adjustment. For example, if you have investment property and in 2023 your investment property is 1 million and in 2024 at the end your investment property is 1.5 million. So if you cannot sell this property, this is only unrealized profit you can get, for example. So you have to be adjust your unrealized profit, but for this one you have to be make an election for this one at the first tax return. When you are going to first city return, you have to make an election for that one, that I will pay the tax on when I realize this profit. Before unrealized profit you cannot go for if you go for an election, then you can minus this one. If you cannot go for an election, that some companies say that whatever I have I will pay the tax, but for this purpose if you gain for the cash benefit is there because in end of 2024 you are not going to pay tax anymore. When you sell this property, then you have a cash in your account, then you have to pay the tax. But this you have to be select an election for this one. If you have an intra-group transfer, for example, if you have a group of companies, intra-group transaction, you have to be eliminate the effect of that one because it should be an arm's length principle. That is another topic, but intra-group transaction you have to be eliminate because you already have a group, you are submitting one CT return, so it's not feasible that you are one company selling to another one with the profit, so you are paying intra-group profit with the for computation point of view. So you have to be eliminate this as well. For corporate tax, the group you can only create a group when you are holding more than 95% share of the company. You have to be submit an application to the authority that I want to make a group of this company. Then you, after that, if you create a group, then you have to be submit one CT return, and then one CT return you have to be eliminate the intergroup transaction as well. This is another topic that you have to be create a group or no, because if you create a group you have to be submit one CT return and only one 375 band is available, and if you go for a 3 company then you have 375 band for 3 companies as well, not for single company. This is basically cost benefit, and you are going for the group, you have to be considered that should I go for the group or no, because in normally if I have 3 companies, one company is in loss, one company is in profit, so then I have to be considered that. Next topic is transfer of losses is there. For example, if we discuss transfer of losses over here, because if you create a group, and in group you can transfer 100% loss to the other company. If you have a 3 company, for example 1 2 3, 2 companies profit, 1 company is loss. If you go for a group, the loss company can transfer 100% your loss to the profitable company. But if you cannot create a group, then you have only 75% of your income can transfer to the group, other company. But you can transfer, but there is a limit of 75%. But in that one you also own 75% of that company as well. There is a transfer of related party as well. If you are transferring anything to the related party or connected person, it should be on arm's length principle. If not in arm's length principle, then you have to take it to arm's length principle and remove the effect of that one as well. Then tax relief and losses relief. This is basically tax relief and losses relief is if you go for international taxation. For example, if our company, we also have a DELTAKAP International. If we elect that our management is here, if they elect, we also pay tax over the company which we have in Germany as well. So any tax which you pay over there, we can reduce over here with that. For example, if we paid 10,000 tax in Germany as well, so we at the end of the computation we can remove that 10,000 effect because we already paid that tax. So it's double taxation agreement. If we already paid over there, you can remove the tax from here, and after that you can pay the tax liability over here. In UAE right now, 142 countries has a double taxation agreement right now. Yeah, Germany is not more. They cannot cancel, but German can cancel this one because here is 9% and German, I think, minimum 25% tax over there. Minimum. If you go for upper band, it's 45%, I think there is a tax rate. So they cancel because this is a low tax treaty country. So they cancel because they said this is a low tax treaty country. So they have to be this one. Any non-deductible expense, for example, if you do any activity that is not taxable, you can incur the expenses over for that activity. That non-deductible expense is not allowed for the computation of taxable income. So any other adjustment, right now there is a lot of ministerial decision will be coming because a lot of ambiguity in the corporate tax as well, because this is the first year for corporate tax over here. So they are adjusting. If something will be happen a new thing, then it should be we need to be consider this one as well. This is a aid adjustment we need to do because accounting profit, sometimes in accounting you have a profit. When do you do this adjustment? Maybe you are in a loss because in accounting you can book as an unrealized profit. If you have, for example, if you have an investment property of the Dubai value is going up, so you book in accounting because the property is up, so you have to book according to IFRS that I have to book this property value on the market rate or at the year-end rate. So if you elect this election for unrealized gain and loss, then you remove that unrealized gain. So maybe the accounting profit will be converted into a taxable loss, depend upon the adjustment. So it depends upon if you have a profit, maybe after the computation it will be loss, but maybe it's lost after the computation it will be a gain. Its IFRS has two different options in investment property. One is the cost base and one is the fair valuation base. If you go for a fair valuation base, then you have to go for every year and go for a valuation company. Please valuate my property. They give you a valuation paper, then you have to be booked in your financial statement. But if you go for a cost base, one cost, then go for a depreciation because you have to book the depreciation at the year end, every year end. So it's depend upon which model you are using. If you go for a cost base, then it's okay. If you go for a fair valuation, you have to go for a fair valuation at the year end, every year end, because you need to be booked for fair value basis. Some non-deductible expense for corporate tax. One is donation. If you see the ministerial decision, they give a list of bodies who is registered in the ministry, non-profitable organization. So if you are giving donation to that entities, only that entity is allowable expense for corporate tax. If you are giving donation to any other person, it's not allowable for corporate tax anymore. You can, but you have to pay the registered authority. Only qualify who is registered in the ministry. I think so. It's only a UAE list. It's not international. If you go for 8 to 9 pages of list of the entities, so you have to be taken from that entity. If you pay to that entity, then you can deduct. If not in that list, then you cannot deduct that entity. Better to go on that 25%, go for 9% to the government entity. If otherwise you are paying 25% totally. Cost benefit analysis every time. If accounting is something different, tax is something different. For tax, you have to be calculate cost benefit analysis over there. That can I go for this one or can I go for this one? It's depend upon every time situation to situation. The second is illegal act, fine and penalty. If you are giving bribes to someone, then that expense is not allowed. But bribes are normally people are giving bribes in the market. So if you are giving bribes or illegal acts to someone, fines to something, that you can not deduct over here. If your company give you a car, if you take a speed limit camera, then company deduct from your pocket. That company will. This is not only norms of the market. If you are, for example, if company give me a car, I go to the Dubai. So if I got a penalty, so I have to pay from my pocket. Yes, yes. Company say we give you a car, we give you a fuel. Company said you have to be pay from your own pocket. So dividend and distribution is not allowable because if one person who have one company, he has, at the year end he decided I will go for a dividend 100%. So dividend is not allowable. You have to pay tax before the dividend issue. So dividend is not allowable expense as well. Drawing of personal use, if owner is drawing something for personal use, it's not allowable expense as well, because owner can withdraw anything. But they said, yeah, this is your personal withdrawing. It's not for the company related. So you have to be remove that effect as well. This is a recoverable VAT is a little tricky. If you have one invoice, the VAT which you paid to anyone else, which you recovered, if you make a proper VAT calculation, it is recoverable. But if you cannot recover, you cannot deduct from here. For example, if you spend 100 dirham and after VAT it will be 105. If you submit that expense in your VAT return, you can adjust 100 and claim 5 dirham from Ministry of the FTA. But if you cannot make this in your VAT calculation, so in corporate tax you can only deduct 100 dirham. You cannot deduct 105 in your expense as well. They said, this is your recoverable VAT. You cannot recover. This is your mistake. This is not our mistake. So you have to be claim only the expense, which is only the amount of the expense. The VAT amount, you cannot recover that one as well. Qualifying income free zone. If you are making exempt supply, then you are not VAT registered anymore. So you cannot claim VAT refund from the authority. You can claim it that one. At that time, you can claim it because you are not VAT registered anymore. So you are doing this with the exempt supply, so you are paying 100%. At that time, you can claim. If you are exempt supply, because this exempt supply is not making the threshold of VAT registration. If you are not making the threshold for VAT registration, then you not go for a VAT registration as well. If you are not go for a VAT registration, then you can claim this expense as well. If you are registered for VAT and you can claim from the authority, but you cannot by your own mistake, then you cannot recover this input VAT over here. And this is entertainment expense. If owners, you can spend money for owner, supplier and customer, then it's only 50% is allowable for corporate tax. If you spend for staff, then it's 100% allowable. For staff is 100%, for owner and supplier and customer is a 50% is allowable expense only. Only 50%. So, they give one example. If you are go for a iftar party, for example, in Ramadan, normally almost every company go for a iftar party in Ramadan. Taking employee with the owners, with the partners, they said you have to be asked to the restaurant make a 2 different bill. One for the owner, one for the employees. By employee, you have to be deduct 100%. For the owner, you have to be claim 50%. Because they said if owner go outside, they don't care about the price. If employee, normally company give up, you have 100 dirham, you can spend 100 dirham. But if owner can give, no one has a limitation. Owner don't have any limitation. If he want to order a beer of 1,000 dirham, he can order, because they said it's the limitation. You have to be pay on a fair value. But a company normally give economy class to the employees. But when owner travel, they go for a business class. So you have to be deduct like this way every in the class, because you have to be paid. He need to be tax as well. You have to be paid tax as well. This article, interest capping rule, personal expenses, non-deductible expense, as we discussed. Interest capping rule is, there is a rule, you have a rule of interest capping. Higher of EBITDA, 15% of EBITDA, 12 million. Which one is higher, you have to be take, but it should be, there is some capping of the interest. You cannot deduct 100%. This capping rule is not for bank and insurance company. This capping rule is only for other companies. So this capping rule for us, not for banks and who has a main income of this as well. You can say like this way, but they specifically say banks and insurance companies as well. Personal expense, if you have any personal expense, you cannot deduct from the corporate tax as well. Incur non-taxable income, for if someone, as your example, that you are spending some money for earning exempt income. If you are not paying corporate tax of that exempt income, you cannot deduct expenses for that one. But if you are paying the tax for that income, then you can deduct. But if you are not paying the tax over there, then you cannot deduct as well from the non-deduct. Loss incurred on non-taxable any activity which you done on a loss basis, that you are not paying a tax on that activity, then you cannot deduct as well. Reasonable apportionment is if you have an office who's generating exempt income as well and as well taxable income. So you have to be apportionment where home, for example, if you go for rent, how much area is used by the exempt staff member who is generating exempt staff and how much area who is generating taxable income. So you have to be reasonably portion that area as well. For example, if our some staff is here sitting in this meeting room who is generating only exempt income, which we are not paying tax on that income. So other staff member is paying using generating income that we have to pay a tax. So we need to be calculate the how much area is using for this staff member and how much area is using. So you have to be reasonable apportionment. In normally the people say this tax they pick from Netherlands. I don't know about the Netherlands but tax, but I see a lot of people say in the market that this tax is 100% copy from the Netherlands tax. A lot of people say that this tax they can pick from the Netherlands. If you read the Netherlands tax, that it's similar to that law because it's the international taxation, because they apply this because they have, I think in my understanding, maybe a lot of international pressure over there, because this is a lot of people is coming here because in their country a lot of taxes over there. For example, if a German company who pay 45% tax over there, if he came here before no tax, for him it's easy that I am earning whatever I am earning is in my pocket. There is no tax over here. So right now, if compare is also 9%, but started with the 9%, maybe they increase, I don't know, but they at least they started, because I think so because of the international pressure over there, because you have to be put some taxes as well. It's not like that you have to be. A lot of company who is not yet registered for corporate tax, they are getting penalties. Last week, FTA generated one email to randomly who is registered for VAT but not registered for city. They send an email to you have to be registered for city as well. But some client who registered for city but did not register for VAT, they send an email to them you have to be registered for VAT as well. If you are not, then it's up your decision. Then this is no, they start pushing to the companies you have to be registered as well. VAT they cannot push because if my our revenue is out of scope, so what should I do for a registration? But they are sending emails to the client to getting the data that they are knowing that this company is registered for. I think in the back end when they said you have to be registered for corporate tax because they need everyone has a data. So they know that every company is registered over here. This company is registered. Mr. Frank has 3 companies, so they have the data of Mr. Frank as well in the Emirates ID. I think in the future it will be more difficult. And if you go to your example for small Pakistani or Indian shops, when you talk to them, they said, we are small company, we don't need for registered. But the law says you have to be registered. If your revenue is less, 0, but you have a LLC trade license, still has to be registered. If you have a license, LLC, you have to be registered. So they have to, they collect data for, I think so. They are going centralized system. I think I listened someone from European guy, he said, if you receive a money in your bank and you did not declare that money in your tax return, for them it will be a fraud. You are doing fraud, something like that. You can, where this money will be came. Personal bank, he said, you also have to declare everything in the personal bank account. He said to me, I'm not sure. You have to be declare everything whatever you are coming in your bank account. Right now it's not here because there is no income, personal income tax, but in Europe there is a personal income tax, so they are treating that one as if you are getting money, for example. I think so they are making the agreement with the different countries for data transfer. If their official request from that company that I need the data for this guy, so they can provide the data this. I think so they for this one maybe the international data relation transfer of data. Next topic, deductible expense is wholly exclusive for the, this is also deductible, not personal in nature, not specific. The main is not capital in nature. For example, if you spend some item for, you buy some system, you buy some laptop, you buy some office equipment, that you cannot deduct 100% of your from your taxable income. So because if you remove 100% from your taxable income will be low, you have to pay low tax on that tax year. But they said you have to be capitalized because you have to be follow IFRS here for small companies and for bigger company. If you are a small company less than 50 million revenue, you can go for IFRS SME. You have 2 type of IFRS. One is for small business, small, medium or enterprises, and one is for fully IFRS. It's your decision. So you have to be follow IFRS. If IFRS says this is a capital in nature, so you have to be depreciated well, not fully booked and expenses out as well. Expense should be belong to the same tax year. A lot of company what they are doing at the year end of December, they stop the generating invoices because this is a year end. So you have to be stop the revenue from this year, go to the next year and making the invoices over in the next year. It's not like this, but a lot of companies are doing, because for the saving of tax, but it's only a time gap. Next year you have to be same problem, then you have to be same like this. It's a just time gap. People want to give a time back. But in service industry, if you have done any services in December 2024, you have to be issue the tax invoice in December 2024. So you have to be. It's not like that you can stop the tax invoicing and in next year you can go and make In December your sale is 100,000 and January your sale is 1 million. It's not, you have to be take care of these things as well. Employees salaries should be arm length, because LLC you can allow as an owner. If you are owner of the company, you have a LLC company, you are allowed to deduct as a salary expense, because you have your own expenses as well. You are living here, you have some other normal regular expenses. You can take the salary, but that salary should be on arm length principle, not in the, you can select I go for a 250,000 dirham as a salary. It's not like this. So you have to be select a salary with the arm length principle as well. As sole, if you are go for a sole proprietor, salary is not allowable, because then for them everything is you. So better to go for LLC, then you have at least some portion of the salary expense as well. In the market they did not give any band that if you have a designation of this you can go for this salary. They only said arm length principle. In the market you have to be checked with the market. If this market is 50,000, you can deduct as a 50,000 as a salary expense, but that salary you have to be debited every month, not at the, for example, if I cannot give salary full year to myself, at the end of the December I said no, I have to go for 50,000 salary, 50 multiplied by 12, and in one transaction. Not like this. You have to be pay monthly salary as well. 100% allowable, because employees, everything you are giving to the employees is allowable. Transaction should be an arm length principle. For example, in the market what people are doing, they hire his son or his any near relation, his wife or his brother, to the company as an employee and give him a salary as a huge amount. But they said you have to take care of arm length principle, and they give a new notification, ministerial decision for who is the related party, connected person. Is a, for example, individual 4 band up and 4 band down. So it should be like this and not like this. People think before that we do like this way, but they are also thinking something for you. So because they need to be, you have to be pay tax as well. So everything is, so they said you have to pay tax as well. Because if you compare in our jurisdiction, where I grow up, I grow in a culture where no tax is payable. No one is paying tax. So if you go in the market and ask any Pakistani or Indian guy or any Asian guy, when we are growing, our elder is not paying tax, because no one is paying tax. There is no culture of the tax paying. I think Filipino also no paying culture. This is a problem, because we grow in the market that there is no tax. So we came here and this is our first year. We need to absorb these things. It takes time to absorb these things, to pay taxes as well.